All right, our content today, we're going to explore how many ways to get 100,000 per annum in retirement. So this is aimed as usual at those of you that are looking to retire in the next 10 years or so, and you might not have worked out your number yet. So we're just going to talk today about 100,000. Now, why 100,000? One's just a nice round number, but we're going to look at all the different ways you can achieve that. There's some very standard ways and some less so standard or outside the square ways. So let's dive in. So firstly, general advice warning. This just means I don't know you, I don't know your stuff. We provide awesome information that can help you get ideas about your retirement planning. But before you do anything, you should either seek out advice or get enough research to make decisions on your own. So let's have a look. So it depends on so many factors, but the two big factors is your return on investment and your legacy intentions. And return on investment is pretty straightforward. Are you going to get a 7% return, a 6% return, a 3% return, a 5% return? The bigger the return you get, the less money you need to produce that 100,000. And I'm going to get really specific, talk about property shares and a few other ways of achieving this. But the legacy intentions one, this pretty much means what do you want to leave to the kids? It could be you want to keep building wealth and leave them lots of money. It might mean you want to join the ski club and spend the kids' inheritance. So these are the decisions you've got, and they will affect sort of how much you need in retirement and how you get that income. So let's do some examples. So here's some examples of where you might have your investments to produce the 100,000. Could be residential property or resi property. So I'm talking about a standard rental property there, or rental properties. Then we're going to have a look at Aussie shares, traditional broad diversified Australian shares. International shares, we'll have a look at a diversified portfolio. I'll have a look at cash and a mix of these. And one other idea that might be really interesting. There's no right answer. I'm not trying to come to a conclusion today because a lot of it will depend on your own plan and where you're starting from and what you already have. But if you were trying to squeeze out 100,000 in retirement, and once again, that's not the be all and end all number. You might need more, you might need less. That'll depend on your own planning. But let's have a look. So the first way to generate 100,000, a diversified portfolio of Australian shares. So the simplest way to do this is through an index-based ETF or exchange-traded fund, something like VAS, which is a Vanguard Australian Share Fund. So it just owns in one share or one ETF 300 of the top Australian companies. Now it pays a dividend of roughly 4%. It's a bit higher sometimes, it's a bit lower sometimes. It also pays a franking credit. The franking credit is just the credit that you get for the tax the company's already paid. So that brings up the return to about 5%, and you get a refund of that franking credit depending on your tax level. And in retirement, you're not going to be paying a lot of tax, but we will talk about that as well. So let's assume it's 5%. Really simple maths. You need a $2 million portfolio. So a $2 million portfolio of broad diversified Australian shares would generate 100,000 of income each year, which would hit our goal here of 100,000. Now, it would also go up with inflation, which is really important because your cost of living is going to go up. So we want to take inflation into account. In all the examples I'm doing today, we're going to take inflation into account. So 100,000 roughly off there, and the $2 million will grow. So it will grow over time. So your legacy in this case would be substantial. Assuming you've got a house as well, you'd be leaving a house on whatever's left in the portfolio. Now, if you had $2 million in an Aussie share portfolio and you wanted to spend more than 100,000, you could sell some of them as well each year to pay more. So we'll explore that when we get to the diversified portfolio. So way number two of achieving 100,000 in retirement, we're going to look at a diversified portfolio of international shares. Now, why am I saying diversified for these first two? Because we're not going to be focusing on one company. If you pick one company, the income could be anything, the growth could be anything. We're looking at the basic principle generally for retirement planning, which is you want diversification. You probably mix up some of the things I'm talking about here, Aussie shares, international, etc. But for this example, I just want to explore to get you thinking about the different ways. Now, international shares, and I've used a proxy here of an index based exchange traded fund like IOO. Now IOO is listed on the Aussie Stock Exchange. It gets you 100. It gets you 100 of the largest companies in the world in one security. So that's IOO. It pays a low dividend. It's 2% or just below. It varies, of course, depending on the companies that make this up. But they're big companies like Microsoft, Apple, NVIDIA, all the Magnificent Seven, and more. So there's no franking credit. You don't get that credit with international shares. You tend to get more growth though. So those companies have grown more than Australian shares, but there's less income. So 3% income. Now the maths here, if you are going to just survive off the income, then you would need $5 million to live off the 2% income. So it's a 2% total return. So that 2% is going to get you 100,000 out of your $5 million portfolio. Now, obviously, it's a lot more money. You wouldn't necessarily just live on 100,000 if you had a $5 million portfolio. But my point here is you don't necessarily need to live off the income either. There's other ways. You could have a lower portfolio of international shares and sell them down occasionally. That would trigger tax. And in this content I'm talking about today, I'm not considering who owns it. You could own all the options I'm talking about today inside superannuation, or you could own them outside of superannuation. But I'm just talking about the cash flow today and the 100,000. So the third way of getting 100,000 in retirement is with a diversified balanced portfolio. So let's just assume a balanced portfolio historically has got a return of about inflation plus 4 to 5%. So let's call it 7%. So let's say you get a 7% return and we're chasing 100,000. And in this case, we're going to draw down like you would from a super. So drawdown just means we're going to pull out 100,000 a year. Now, whether that's a monthly amount, a half yearly amount, a quarterly amount, whatever, the maths is pretty much the same. So we're going to draw down $100,000 from a portfolio. Now, if you had a $2 million portfolio and you're getting an average total return of 7% and you were drawing down 100,000 and you lifted the portfolio every year with inflation, you'd need $2 million for it to last 50 years. That means you'd be totally certain you're never going to run out of money, assuming you're retiring somewhere in your 60s. If that was too long, if you want to draw it down sooner, you could actually get the same result, $100,000 per year, rising with inflation, from a $1.5 million portfolio. And that $1.5 million would last about 25 years. So different amounts, major impact here, the major difference between the 2 million and the 1.5 million starting point is how long it's going to last. So you'd run that down over 25 years. Now that might be by design. If your plan was to retire at 65, you might go, well, 25 years takes me to 90. I'm okay with that. Or I'll slow down in the last bit or whatever. And that's down to your individual planning and something I'll talk about later, but not for what we're talking about today. Now, if someone had $1 million in a diversified portfolio, whether that be super or outside of super, and they drew down 100,000 rising with inflation, that would last them about 14 years. Now, once again, that might be okay. They might also have a property they're going to downgrade. So it just, and you can play around with a lot of this stuff if you've got access to a good calculator, which we certainly do. I'll talk about that later as well. So way number 4, cash and term deposits. And when you think about term deposits at the moment, as the time of recording, you can get 3.5 to sort of low 4s. Historically, term deposits have delivered about 1% above inflation. So if we assume inflation will settle at about 2.5%, you're going to get about 3.5%, and that's your whole return, the interest. There's no growth, unlike the other things we've been talking about. There's just the coupon or the interest rate. So 3.5% return. So if you wanted 100,000, you'd need $5 million to start with, and that would last you about 50 years. So it would still draw down over 5 million. Now you contrast that to the diversified balanced portfolio, where $2 million lasted 50 years. So you actually need way more if you're conservative and you only want to invest in cash. And most people just wouldn't do that. So $2 million portfolio, once again, which lasted 50 years for a balanced risk profile, with a 7% return, with only a 3.5% return coming out of cash, would only last 22 years. A $1.5 million portfolio would only last 16 years, and a $1 million portfolio would only last 10 years. So you can see that cash alone is never a good solution unless you've got oodles of money and you don't want to take any risk. But you would be letting down the potential of what you could get. But it does happen from time to time. I had someone come and see me about 15 years ago, and they'd worked in business all their life, and he'd sold a business. He had about $10 million. I took him through all the different returns, all the different risk profiles, all of the different things he could invest in. And he said, you know what, Rob, I'm sick of taking risks. I've done that for the last 20 years. I've nearly gone broke 3 times. I'm just going to invest it in cash. Now, I never met him again, so I don't know what he did with that, whether he stayed in that. I imagine it'd be rather boring. But $10 million, it would have lasted him a long time, I imagine. But that's not the luxury that most of us have. Most of us don't have anywhere near that, and if we did, we'd probably want to spend more money as well. So let's have a look at way number 5, residential property. So we're talking about rental properties that people live in, that you rent out, and they pay you rent. You've got some costs. Let's make some assumptions. Let's assume you're going to net 3.5%. So yeah, and 3.5% would be after the rates, etc. Now, generally, this will vary in different cities. So if you're in Sydney, rents tend to be a bit lower as a percentage. And if you're in rural areas in Australia, the rents tend to be a bit higher. But let's use 3.5% net rent as this assumption, and we're chasing 100,000. So you'd need 2.85 million of properties to get 3.5% net rent, which would give you 100,000. Now, if that 2.85 million a property, that could be 3 properties at about 900,000. It could be 4, at about 750,000, and that would give you the cash flow of 100,000 a year. Now, the nice thing about that is it continues to grow. So every year the rent's going up, so the value of the property goes up. So you happy kids and grandkids, the legacy impact is better than if there's a lesser amount. So this is the thing about resi property. If you've got oodles of it, it can provide really good income in retirement. But one rental property won't cut it. Let's say you just had one rental property, and let's just round it to $1 million. It's going to produce 35,000 a year. You can't sell it off bit by bit. So it's not very suitable until you get into the 3, 4, 5 investment properties before you've actually got a decent amount of income. Now, you're not getting as much income as you could, because this same $2.85 million of property, if that was invested in a diversified portfolio, is actually going to get you about 150,000 a year or more if you're happy to draw it down somewhat as well. So once again, it gets back to these 2 big things. What's your legacy intentions? How much do you want to leave to your kids? And what return are you targeting? You'll see that we're talking about income return on these, on the shares, the property. So it's the return that you get, rental, dividends, distributions. But in the long run, it's the total return that also affects what you get. So that might be, in superannuation, say a 7% return. Or for property, as well as the rent, you're getting capital growth as well. So let's have a look at way number 6, commercial property. So commercial property includes things like offices, industrial sheds, shops. They're all classified, commercial, residential, industrial. So we're talking about non-residential property here. One of the characteristics of these types of properties is they tend to have higher rent, and whoever's renting it pays nearly all the time most of the costs, including the rates and all the outgoings. So it's quite a unique investment for people in retirement, because it doesn't have the same costs that residential property. The rent at the time, now the rents will vary depending on the areas, but let's say the average rental yield for a commercial property is around 5.5%. So at 5.5% rental yield and our 100,000 target, we need 1.8 million of commercial property. Now that might be 3 $600,000 shops. It might be one big office building. But let me talk a bit about some of the risks of commercial property. When I'm talking to clients, I sort of say commercial property can either be your best investment or the worst investment, and it depends on whether you've got a tenant. If you've got a tenant the whole time you own a commercial property, it's an awesome investment. The leases tend to specify that the rent goes up each year with inflation, and every 5 years or so there's a market review where if inflation's gone up, if the rent's gone up by more, in that area, it pushes the rent up as well. The tenants pay all the outgoing. So if you've got a fully tenanted commercial property, it's absolutely magic. They don't always stay that way. You've seen vacancy signs up. A commercial property I had back during the GFC was vacant for 2 years. So that was 2 years with no income. And if you borrowed, obviously that's no good. But also if you're retired, it's no good. You're not getting your income. So commercial property, I'll repeat that, can either be the best or the worst investment you've got, depending on the tenant. It's very black or white. It needs special expertise. Most of us understand residential property. Commercial property is a whole another beast, because it's all about getting the right tenant. And then obviously there's maintenance on property as well that I haven't really taken into account for the purpose of today's content. Now, commercial property will continue to grow. It generally doesn't grow by quite as much as residential property because they tend to make more, but it can. So once again, happy kids, it's a great legacy. If you own property and if you can live off the rent, the legacy to the kids and grandkids is going to be higher than if you're spending it down like we tend to do with super. So commercial property, you see 1.8 million there compared to 2.8 of residential property. So for someone retiring with $2 million, having some commercial property may be viable, but it does also come with the hassle factor, tenants, leases. Over the years I've owned commercial property. I've had lots of clients that have owned commercial property. And like I said, when it's good, it's really good. But then when there's vacancies, it can be really bad. And particularly if those vacancies occur at a bad economic time, during a recession like we had in the GFC, and there's just too many properties. Residential property tends to have vacancy rates in the 1 to sort of 3% range, where commercial property can sometimes be vacant for a long time and have higher vacancy rates in an area. So let's have a look at a different way. So we've been talking about amounts of 1 million, 2 million, 3 million, 5 million to generate 100,000. Let's say we've got someone though that's got nowhere near that amount of money, but they might have a house. And let's say they've got a house worth 1.5 million. And let's say they've got a little bit of super, in this case 400,000. And they've been earning okay, so they've been spending more. They've heard that the age pension's about 45,000 for a couple, and they know that that's not enough for them. They've been spending more. So let's talk about, once again, return on investment. In this case, we're adding a third element, return from the government. But legacy, we're going to add a reverse mortgage to it as well. So we're going to source out 100,000 from 3 buckets. Now, to get an age pension, and watch out for other content I produce on that, but to get a full age pension, you've got to have assets of around 400,000 or less. It's a little bit more than that, but by the time you allow for the car. So we're going to assume in this case the 400,000 of super is low enough that they get a full age pension, and a full age pension is $45,000 a year. Now, if they also draw $25,000 out from their super, that super will last 30 years at a 7% return. So they're starting this at age 67. So 30 years later, they're 97. They're running on their super. They're still getting an age pension. They've still got their house. And if they supplement this, so 45K for the age pension, 25K for super pension, that gives them $70,000. So if they took out a reverse mortgage, and a reverse mortgage can either give you a lump sum or it can give you regular payments. And a reverse mortgage is just where you borrow from an institution against your house, and they don't require you to pay back anything until you either sell the property or until someone sells the property, either you or your estate. So it's a great way for people to tap into their house. There's plenty of the baby boomers that have a big house and not enough super. So this is a really valid solution for those that are prepared to spend some of the house, so to speak. Now, it will take away from your legacy somewhat, but you'll see in this example, it's not as much as you think. So we've got a $1.5 million house. Now that house, if it grows at 3.5% per annum, that house, when this couple is 97, if they make it that long, is worth 4.2 million. It's future dollars. What would the reverse mortgage be? Pulling out 30,000 a year for the next 30 years, the reverse mortgage would be up to 1.3 million. So some people might say, "Oh, that's terrible. We've borrowed 900,000, but we owe 1.3. We have 400,000." But look what the house has done at the same time. So the house is 4.2. So that loan to valuation ratio is 31%, or if they sold up, if they passed away at that time and they sold up, there's still just under $3 million left for the kids. Now, this person didn't have enough money in their super to generate 100,000. If they took 100,000 out of their super, they would have spent it all in 4 years. Then they would have been on the age pension of 45,000 a year forever. And the age pension does go up with inflation. So this is where, good planning, good knowledge of all this stuff comes to the fore. And we're talking a lot about in stuff like this, rules of thumb. But ultimately, you've got to get down and do your own calculations, do your own planning. And whether you go to an advisor or whether you learn from content like this and other things, it doesn't matter, but do the numbers. What otherwise happens is people don't spend as much as they could. So in this case, someone's got 1.5 million in a house, and if they really don't want to leave the house, they probably just wouldn't spend as much. They might try and get by on the age pension, and they might take that some 20 to 30,000 out of their super, so they're getting by on 75,000, and they'd work out how to get by, but they're going to leave a lot of money to the kids, and they will have suffered by not spending as much as they could have. So the reverse mortgage provides a good outlet. I helped my late mother set up a reverse mortgage when she was in her 60s. She had a nice unit, but she didn't have much in super. It was about 30,000. My parents had divorced, so I had early exposure to reverse mortgages, and this was about 25 years ago. Her experience was really good. She got extra money for travel and other things. She eventually sold that unit, moved into a retirement village, and the loan didn't even touch the sides. It was very modest compared to the value of the unit by then. So they've been a good story for some people. Not for everyone, but they are a valid tool in the retirement kit. So then I'm going to look at the last one. I'm going to look at 100,000, where someone's just got the same example as before, just got 400,000 in super, and they've got their house. And in this case, let's say they've got 400,000 full stop. They actually decide to spend it on a granny flat or updating the house so they can put, they can get some rental income. This isn't for everybody. Some people, it's their worst nightmare, having a rental property in their house or trying to earn money from Airbnb. So what we're trying to do is squeeze that extra money. So same scenario, 45,000 from an age pension, 30,000 from a reverse mortgage, same numbers as the example before, but this time instead of 25,000 from super, they're going to generate 25,000 from their house by either having a granny flat or some rooms that are cut aside, and or 30,000 from Airbnb. Now they have different tax implications. I'll touch on that in a minute. So this couple who only had 400,000 spent it on a bit of property. They didn't like super for whatever reasons, or they might have had no money, but they've had a house that was suitable to the kids have left home, so there might have been a downstairs area. They all of a sudden they can rent out for $400 or $500 a week, and it's amazing what these sort of things are getting. So in this case, the house is going to grow by 3.5% per annum again. That's our assumption, at least. It might grow by anything, lower or higher, but we're going to assume 3.5%. Once again, 8.5% on the reverse mortgage. So same numbers as before. If they make it to 97, the house is worth 4.2, the reverse mortgage 1.3, and they've enjoyed 100,000 of income all that time. Now, part of when they sell it or when their estate sells it, there may be some capital gains to the extent, well, there will be some capital gains. So whatever, let's say the granny flat or the rooms they're renting out is 12% of the total land, the total floor space of the properties, then that portion will be subject to capital gains. So they lose some money there. So hopefully that's given you a bit of an overview of different ways to generate money. Now it's deliberately teasing, how many ways are there to get 100,000 retirements? There's lots of ways, and the conclusion is there's no one way. A big part of it depends, and I always talk about that the best financial decisions are made as part of a real plan, and a real plan which you can see on our 5 essential steps to an awesome retirement. This is available for download at our website if you haven't downloaded it already. But a real plan just has these 5 bits. One is it's a stock take of exactly where you're starting. Then it has your retirement goal. So in this case, we've been working around a goal of $100,000. And then we've just explored different strategies to do that. Now, depending on someone's starting point, a lot of these strategies are not possible. But you can see, even at just a house, we're able to work out how to do it for someone, or just a house and 400,000 worth of super. But if someone had 1 million, 1.5, 2 million or higher, there's different strategies that they can use. And a lot of it, the main impact was on the estate planning. So you can download that there. Other ways, and you'll find that on our website, Runway to Retirement. I've got a framework I use to help people work out how to get stuff done. And this framework rests on two axes. For those of you watching the video here, you can see the two axes. The first is knowing what to do. And let's say people fit into one of three categories. And let's say it's retirement planning. They know what to do. So across the top axis, we've actually got, I want to do it myself. I'm happy to do everything myself. So we've got three options here. That's the first one. Second option is I want to do it myself, but I want someone to show me or guide me, to hold my hand through it. And the third option is I want someone to do it for me. So let's take that first option of knowing what to do. So in this case, if someone knows what to do, but they want someone to do it all for me, it's easy. You get advice, you find a good advisor, you get them to do it and support you in an ongoing basis from there. That's easy. If you wanted to do it yourself and you know what to do, you just need to do it. Now, if you haven't done it, you've got to question whether you really know what to do and whether you're really confident in what to do, or whether you're still learning. Now, if you're learning, that's fine, and that's that middle category. You want to do it yourself, but you prefer someone to show you, so they can show you some of the gaps in your knowledge, and then you can get on and do it. JFDI, one of my old bosses taught me that acronym. It was, once you know what to do, once you know how to do it, JFDI. So it's Nike's slogan of just do it, with a bit of an exclamation in there with the F. So what if you don't know what to do? So then you go down a layer on this and you know some of the things what to do. So you know a little bit about super, you might know a little bit about property. Now, if you want to do it yourself, you've got to do some more learning before you can get it done. So you can learn from practical experts. That's what we do at Runway to Retirement. That's why we do the podcast. That's why we do all the content that we can do. So people that would prefer to do it by themselves have options to learn. And I'll talk more about those in a minute. And if you clearly don't know what to do, you've also got to learn from experts. Now, I should point out that if you know some of the things you want to do, or you don't know what to do, but you'd rather someone does it for you, then we can also help you find a good advisor that has principles and values similar to all the things that we talk about. So wrapping up there, final thought is, jump onto our website if you need to, www.runwaytoretirement.com.au, and there's lots of information there on any of the ways that you need to be helped, whether that's getting more information or getting advice. Good luck with your retirement planning, and feel free to message us on ideas you'd like to see in these podcasts, and I'll see you in the next episode.